This trader turned a few $1,000s into over 100 million. His win rate, just 25%. He lost 3 out of 4 trades. One strategy did most of it, the breakout. So we asked, does the rule itself actually work? We're ordinary people with real data. Case number 2, the Qullamaggie breakout. Here's how it works. This is Tesla in real candles with its 10 and 20-day average lines. Every day he scans the whole market for the top 1 or 2% by momentum, the biggest gainers over the last few months. Tesla's already made its big move, up over 30%. Now he waits. Instead of chasing, he lets it pause. It pulls back a little, the range tightens, and it rides right along those average lines. That coiled pause is the base. When price breaks above the top of the base, on real volume, at least 1.5 times its average, he buys right there with his stop at the low of that day. A few days in, he sells a third into strength and trails the rest along the 20-day line until a candle finally closes below it and he's out. So where's the catch? Most breakouts just fail, like this one. A tight base, a clean breakout, then straight to the stop for a loss. Knowing in advance which breakout is the real winner is his chart reading, his experience, his feel, and even he wins only 1 trade in 4. That's how hard the picking is. His edge is choosing winners big enough to pay for all the losers. We can't reliably do that. So we did the only thing we can, apply the rules mechanically to every breakout and let the data decide. One thing up front, this is a mechanical approximation of his public setup, not a replication of his discretionary trading. So we strip out the picking and test only the mechanical rule, as strictly as we can. Real costs on every trade, no peeking at the future, and we keep the stocks that later got delisted, so there's no survivorship bias. Now, does the rule alone actually work? Same $100,000, same 11 years. His full rule, breakout with the volume filter, grew to about 290,000, the S&P 424,000, the Nasdaq 724,000. It stayed over 90% invested. It wasn't hiding in cash, it just couldn't keep up. And this version didn't lean on a lucky few trades, it was broadly built, and it still trailed the market. But could we push it any higher? We tried. Fairly. Could anything fair push it past the market? We went the other way first. Strip out his volume rule, and it's just a naive breakout. The return collapses to under 4% a year. That volume filter was doing real work. Put the volume rule back, his real setup, and you're at 10.1% a year on a broader, healthier record. That's his honest best. And it's still under the market's 14. So we piled on more smart filters, a market regime switch, relative strength, tighter risk, fewer trades, more cash, and the return fell right back to the low 3s. Nothing we built honestly beat just buying the index. So here's the paradox. Tested honestly and mechanically, the rule loses to the index. Yet the man famous for it turned a few $1,000s into over 100 million. Both are true. So the money never came from the rule everyone copied. It came from the one thing the rule can't capture, which breakouts he chose to take, and how hard he bet on them. Start with the raw funnel. Every day, he scans the entire market. Our backtest did the same, and over 11 years, the rule flagged nearly 8,000 qualifying breakouts. 8,000. A computer can take every one. A person can't, and more importantly, shouldn't. So he filters, ruthlessly. Only the strongest prior move. Only the most explosive, highest range names, the ones that move violently when they go. Only the tightest bases in the leading sectors at the moment the whole market turns up. Thousands of signals collapse into a watch list of a handful. That brutal narrowing, the taste for which few are actually worth it, is the part you cannot write into code. And when he's right, he's not a little right. Here are 4 the setup genuinely caught in our test. Real tickers, real dates. Tesla, up 106%. Avis, 125%. Upstart, 86%. Rigetti, 149% in 5 weeks. One trade like these can pay for dozens of losers. That's the real engine of this whole style. Rare, violent winners. The entire game is being sized into them while they run, and barely bleeding on everything else while you wait for the next one. And the data says it plainly. Out of about 2,100 trades, the top 10 made 78% of all the profit. 10 trades. The other 2,000 combined made barely a fifth. So his edge was never the entry. Every retail trader has the entry. It was the eye to spot those 10 before they ran, the conviction to bet big when he did, and the patience to sit through hundreds of duds. That's the part that isn't for sale. And here's how those monsters actually got so big. It isn't just the entry. The moment a trade goes against him, he's out. A small clean loss, no debate. But when one starts working, he sells just a third into the first surge to bank it, and trails the rest behind the moving average. That's the whole secret to the fat tail. Tiny losses on the many that fail, and the patience to let the rare one run for months instead of selling early. The rule gets you in the door. Cutting losers fast and refusing to sell your winners too soon is what lets 10 trades become 78% of the profit. And here's the honest, uncomfortable part. The math only works if you do 3 brutally hard things at once. You cut the losers fast, a small, disciplined loss every time, no arguing with the chart. You let the rare winners run instead of grabbing a quick profit, and you bet meaningfully on them, right when they feel the scariest. Most people do the exact opposite. They hold losers hoping and sell winners early. So is it a scam? No. Is it copyable? Also no, not the way it's usually sold. The breakout rule is real, and on its own, it's a below-market strategy with gut-wrenching drawdowns, the 100 million lives and the discretion wrapped around it. The rule you can copy in an afternoon. The temperament took him years, and that's why the number is his, not ours. And one caveat, because honesty is the whole point. He traded intraday, on the opening range, watching every tick. Our test used daily bars, a deliberate mechanical approximation. A sharper version might improve the entries a little, but it cannot manufacture his judgment. The distance between our 10% and his 100 million was never the data. It was him, so the setup was never a secret. It's on YouTube for free in 100 videos. That was never the part you were missing. What you were missing is the 10,000 hours behind the eyes making the pick. That's the honest scorecard on the Qullamaggie breakout, a real public edge, wrapped around a private skill no rule can hand you. So this isn't Qullamaggie failed, it's the opposite. His public rule, tested honestly and in full, volume filter and all, still loses to just buying the index. His 100 million almost certainly came from the part we couldn't copy. The eye to hand pick, the real winners out of that daily list. The rule is the easy part. The pick is the edge. So what should we test next? A famous strategy, a viral one, or the one you're running right now? And if this saved you from a strategy that only looks perfect on the winning charts, a like and a subscribe genuinely keep these honest tests coming. Thanks for watching.